Good morning, everybody, and welcome to Inside India. I'm Sri Jegarajah, your headlines. Markets resume their slide and the bond market ticks higher again as fears of the escalating US-China trade war continue to rattle investors. India targets $500 billion in two-way trade with the United States within the decade as the country looks to move swiftly on a trade deal. And India's top IT services exporter TCS warns the US tariff uncertainty will hurt business as the country's largest IT services exporter reports weaker than expected results. We will be hearing from a company's CEO coming up later on in the programme. Right, let's take a look at the Asian markets and what a week it's been. A historic week in terms of the volatility. We haven't seen these kind of moves and gyrations since the pandemic era. So a reversal in the historic relief rally that we saw midweek. The 90-day timeout as a positive catalyst. That wore thin rather quickly. Now the markets are pricing in escalation between the two world's largest economies. US-China retaliatory spiral, that remains a big negative narrative, and the markets continue to price a deeply negative scenario for the global economy. And look no further than dollar and treasuries for an expression of this. US exceptionalism getting trashed, US assets from stocks, dollar and bonds being dumped, and just very quickly the dollar saw its biggest plunge since 2022. So that's the backdrop, that's the narrative. We did see a big sell-off on Wall Street overnight, giving up gains from Wednesday's historic rally. The Dow sinking 1,000 points, down 2.5%. S&P 500 down 3.5%. US equity futures also tipping more downside when Wall Street reopens tonight. As you can see there on your screen, that's the equity futures picture. The markets could still end the week higher after that massive rally yesterday, though they are still 6% lower month to date. Bear in mind, we are heading into US earnings season, so the guidance risk could be an issue and could be a challenge for these markets that are already in a very fragile situation. We're also watching the US dollar, the DXY sliding to 100. That's its lowest in 6 months. We are seeing a degree of stabilisation, so perhaps this level of 100, the century mark for the dollar index, represents something of a near-term floor, but still, as you can see there, down by about 0.7%. We continue to see money flowing into the relative safe harbour of the Japanese yen. Dollar-yen rate now at 143.50, down by 0.7%. Let's give you the Indian rupee, of course, as well. Dollar rupee rate at 86.2640. Now, the Indian markets join us in about 45 minutes' time. Here's what GIFT Nifty futures are indicating. We're looking at a kick-off in the region of about 22,940. So that will represent something of a lift for the Nifty 50. Remember, arguably, there is some pent-up buying demand, given that the markets yesterday were closed. And the markets are going to be engaged in a lot of push-me, pull-you activity. But from the here and now, at the get-go, the Indian markets are going to take their cue from this US tariff reprieve, but expect some volatility in the course of the trading day for the Indian markets, for the Nifty and the Sensex. India, in the meantime, pardon me, bear with me. India, meanwhile, one of the first countries to get the ball rolling on a trade deal with the United States in hopes of concluding the first phase of the second half of this year. Trade Minister Piyush Goyal speaking more on how much two-way trade they are targeting.
India has been handling the tariff issue wisely for a long time. Prime Minister Narendra Modi and President Donald Trump had decided in February to sign a bilateral trade agreement while strengthening mutual cooperation. This will help India and the United States to make trading easier and smoother. It will also help the two-way trade reach $500 billion. That is 2.5 times more than what it is worth today.
Now, India is also strengthening ties with multiple countries amid the tariff-induced volatility, and Singapore remains one of its key trading partners. The city-state is one of the largest foreign direct investment contributors to India, and the partnership extends to sectors like services, aviation, IT services, aviation, semiconductors, and a new green digital shipping corridor that was signed last month. To enhance cross-border trade further, India is also planning to streamline customs processes with Singapore. Accredited exporters and imports could benefit from the deal that's expected to be finalised by June. I'm delighted to say Shilpak Ambole is joining us now. India's a High Commissioner to Singapore. Mr. Ambole, thank you very much indeed for joining us. So, India and Singapore historically have always been very closely aligned, and this cooperation that we're seeing now well predates the tariff-related uncertainty and volatility. But would you say there is greater urgency now for India to forge even closer ties with Singapore and Southeast Asia?
Well, as you rightly mentioned, first of all, thank you for having me today on the show. As you rightly mentioned, Singapore and India relations are very historical and have gone back centuries. The trade and investment part of the relationship is particularly very strong, and it continues to be strong. What has happened in the last last decade or so in India, we've had a very stable political government, a reform-oriented government policies are being undertaken, and our economy has started growing and focusing on sectors which were not focused on earlier. So from the Singaporean point of view, you have a big market which is providing stable returns and is on a trajectory to grow at 6 to 7% for the next 2 or 3 decades. We are the 5th largest economy in the world, on the way to become the 3rd largest economy. So from that point of view also, Singapore has an option of kind of diversifying its investments and trade from the East Asian countries to a country in South Asia. Having said that, I'll just briefly touch upon what has happened in the last 1 year in the India-Singapore relationship.
Yes.
Our Prime Minister chose to visit Singapore in the first 100 days of his 3rd term. He was very keen to visit here. Lawrence Wong had also taken over as a new Prime Minister. So we wanted to focus on building a strong relationship between our two Prime Ministers, and which the visit did achieve that objective. And we decided to elevate our relationship from a strategic partnership to a comprehensive strategic partnership, because we've had 10 years of strategic partnership and we've done a lot in various sectors. So that was one of the important outcomes of that visit.
Shilpak, what is bilateral trade between India and Singapore worth now, approximately? And do you have an aspirational target on where that's likely to be in 2030, let's say?
Roughly about $35 billion is the trade figure. But more than trade, we are also focusing on investments. And now what has happened is we've identified 6 new sectors for collaboration. We have what we call as the India-Singapore Ministerial Roundtable, which is a very unique mechanism. Not many countries have it in their bilateral relationship. It was started in September 2022, where we had 7 ministers on both sides spending time together, discussing regional global issues as well as bilateral relations. And we had the second iteration in August of 2024, where we had a total of 10 ministers, 6 on the Singapore side, 4 on the Indian side. And we identified 6 areas for collaboration, which included skilling, connectivity, advanced manufacturing, health, the whole digital sphere, and advanced manufacturing like semiconductors. So we've now started focusing on these specific areas, including specific projects on the ground.
Advanced manufacturing is an interesting one, Shilpak, because India does have aspirations to be a semiconductor powerhouse. So what would you say is the value proposition for Singaporean semiconductor companies to expand further into India?
Well, as you rightly said, not many people know, but Singapore is one of the critical nodes in this whole semiconductor global supply chains. They have few clusters of semiconductor ecosystem which have been functioning very well for a few decades now. Now, India has now decided to go into semiconductor manufacturing, both in assembly, testing, packaging, as well as the fabrication unit. And we want to learn from Singapore as to how to build that ecosystem, both in terms of the physical presence as well as how how you kind of get the small SMEs who are present, who are gas suppliers or tool equipment manufacturers or certain substrate producers, how to get those companies into India and how to build that ecosystem. So in that sector, we've signed an MOU with Singapore during our Prime Minister's visit. We have a joint working group going on who are identifying how to kind of take it to implement it on the ground, and that is progressing very well.
How does AI fit into that bilateral narrative?
Well, it's part of that because we have, as well as the digital dialogue going on between the two corresponding ministries, which does discuss how to kind of collaborate further on AI, and that is also ongoing.
And this touches on fintech and payment systems as well, doesn't it?
Yes, it does. Because as you know, we've had a very successful digital payment infrastructure in India. We've had a link with Singapore 2 years ago, the UPI Pay Now link. It's both for remittances as well as merchants payment, and we are trying to expand it further by getting more banks onboarded on the platform.
Shilpak, moving on to transport and logistics, India and Singapore last month signed a letter of intent to develop a green and digital shipping corridor. How do you plan to realise and build on that and make it a reality?
Yes, you're right. If you see in our budget this year, we've made a lot of announcements in the maritime sector.
Yes.
In our parliament, there are 5 bills which have been tabled. 2 have been passed. 3 more will be passed in the next session. This is to really reform the whole maritime sector. Now, where you talk about the green transport, we've identified 3 ports, 2 on our eastern coast, which is Tuticorin and Paradeep, 1 on the western side, which is Kandla, which will be used for green fuel bunkering. So we'll be giving a lot of incentives for people to manufacture green hydrogen, green ammonia, and green methanol, and which will become part of the green shipping corridor. Because once you have a green ship, which is a dual fuel ship, moving, say, from the east or through the Pacific to the Atlantic, you will need bunkering stations on the way. And India fits in very well in that green shipping route.
There's also green ammonia too, and Sembcorp is setting up a state-of-the-art green ammonia plant in Tuticorin in Tamil Nadu to produce green ammonia to export to Japan.
Yes.
Can you give me a sense of where that project is, the status of it, and are we going to see more in India?
Sembcorp is looking at Tamil Nadu. Also, the part of the project extends to a state of Odisha and the port of Paradeep. The Odisha Chief Minister was here in October. President Thurman also visited Odisha in January, and Sembcorp is actively looking at developing that project. They just recently signed a joint venture agreement with one of our big public sector oil marketing company called BPCL. So both will collaborate on that front as well. So the Sembcorp project is going well, and they are actually expanding their presence in India.
Shilpak, very finally, India plans to build 12 new industrial cities. And given Singapore's track record and experience in urban development and industrial parks, can we expect more investment into urban development?
In fact, the company we talked about, Sembcorp,
yes.
They are very specialized in operating industrial parks. We know their experience in Vietnam. So they are actively looking at 3 or 4 sites in India in different parts, one in Tamil Nadu, one in Odisha, one in Rajasthan, where we are actively looking to how use their expertise and develop our own industrial parks. So we are in advanced stages of negotiations on those fronts.
Shilpak, thank you very much indeed for bringing us up to speed with the prospect for closer and deeper Singapore-India commercial ties. We appreciate your time, sir. Thank you.
Thank you.
Shilpak Ambule there, the High Commissioner for India to Singapore. Coming up next, we'll hear from India's largest IT services exporter, TCS, of course, the company reporting weaker earnings and warning the tariff uncertainty is not good for business. CEO joins us next. Welcome back. US tariff uncertainty dampening fourth quarter results from TCS. Revenue growth slowed to 2.5% in Q4 compared to 3.6% in the preceding quarter. The Indian IT services giant flagged clients are holding back on discretionary spend amid tariff unpredictability. However, it hopes the uncertainty will settle over the next few months. About half of TCS's revenue comes from North America. Let's bring in K. Krithivasan now, CEO and Managing Director at Tata Consultancy Services. Sir, thank you very much indeed for joining me this morning. From a guidance point of view, first of all, how would you characterise business conditions and overall demand in the next quarter?
Good morning, Sri. I'll first talk about the demand and then I'll talk about the market conditions. We declared yesterday that we closed order book close to about $12.2 billion, which is still one of the highest for us, considering that there is no mega deals in this one. And even within the $12.2 billion, almost $6.8 billion came from North America itself, and we had a good order flow in the BFSI sector as well as in the consumer sector. And if I also look at the overall demand for our services, yes, there is a certain amount of uncertainty, and we did call out yesterday. Some programs have been held back, but at the same time, there has not been major project cancellation. So I would characterize that there is some uncertainty, but there is no panic. There is some softness in some sectors, specifically like consumer business. But we are also finding good traction in sectors in banking, particularly financial services, aerospace. So there are sectors where we are also continuing to find good growth.
I understand. How challenging were the international markets for you, especially Europe and North America? We are hearing that clients are cutting back on discretionary spending. There may also be impact on TCS from government contracts and government spending, given all these DOGE cuts and the federal layoffs. What's the follow-through, and how concerned are you about those two markets in particular, Europe and North America?
So, Sri, unfortunately or fortunately, our government exposure in these two markets is very, very limited. Okay, we do government work or the public sector work more in India, and we do have some presence in UK, some presence in Netherlands and Australia, but US it's very small. So that is not the direct impact for us. But there could be derivative impact coming because of that, like government spending less or government cutting contracts with others. Will it have any knock-on effect? There could be some.
Yes.
But I'm not particularly worried about federal spend cut itself, and at least from our business profile. And also, as I said, you talked about discretionary spending cuts. As I said, what we have seen so far is not any major cancellation of programs. Some programs are being paused, particularly in some sectors. But otherwise, there is no major spending cuts. We have not heard officially a budget cut for the year from any of our customers, Sri.
I understand. I just wanted to press you further on that, Mr. Krithivasan. How concerned are you about enterprise spending and demand in future quarters, given this climate of uncertainty? Because many people are drawing a parallel with what happened in the pandemic era. Could it be as bad as that?
I hope it is not, because as I said, we are not heard of any budget cuts. And also my belief, Sri, is this will settle down in the next few months maximum.
Yes.
Because this is not like a pandemic where it was beyond human control. This is something eventually the governments will come together and agree on with the way forward, and things will settle down. I won't draw the parallel with COVID, where it was unprecedented. It was beyond most of our control.
I understand. The upgrade cycle, secular demand, for AI-related solutions to improve efficiency and productivity. Do those positive drivers remain intact for TCS, or are customers putting those plans on hold?
No, because this is a technology where we find most of our customers want to lean forward. In fact, I've seen situations where our customers, even though the ROI is not clear, want to stay invested so that if you're left behind, the winners may have a big advantage. So everybody wants to participate. And we are finding two different kinds of programs coming in. One where what we call AI for business, like delivering business efficiencies or in terms of customer experience or ability to deliver new services that were not delivered before. And the second is AI for IT, where it brings in productivity in terms of software engineering. We are finding that both kinds of programs are really taking off. And still it's on a small base, because when I say there is a lot of traction, I don't want to give you the impression that it's a significant or material revenue driver at this time. But if you look at from a discussion perspective, maybe every other customer we have discussions around this.
Mr. Krithivasan, a number of analysts have cut the stock price and cut the recommendation and downgraded TCS. Do you feel that that is unjustified, or what do you think is leading to this view?
So I think, most of the analyst recommendations are coming from their overall perception of the macro. And we believe that, as I said, we have a good set of order book. We are in constant touch with our customers. And I've been telling since yesterday, we are still hopeful that we will have a good year. Like we just starting the year, we are still hopeful we can have a good year.
Yes. So sector growth has been challenged. Uncertainty will make it tougher. Valuations remain high in that context. This is Citi's take. So what would be the counter-narrative from TCS to that view?
I don't want to call it a counter-narrative or to dispute. Everybody is putting what facts they see. The way we see it is there is a strong order book. Customers are wanting to invest in technology because many organizations have a huge technology debt. And the new, particularly technologies like AI, also create more opportunities. For instance, we are doing a large program of migrating 50 million lines of code for one of our customers. This would not have been possible without technologies like generative AI. So it's creating more opportunities as well, which are not there or which probably customers would not have taken up in the past. So I am not as pessimistic as some of them would be.
I see. March was a tough month, Mr. Krithivasan, for tech sector layoffs, with HP, Northvolt, Ola, all cutting headcount, and I believe over 8,500 people in the tech sector lost their jobs. For TCS, how much pressure is there to reduce headcount in this environment?
Like yesterday, our head of HR announced that we'll be hiring more people from the campus, and our lateral recruitment plan also is intact. So we are not looking at in terms of laying off people or even reducing hiring. It will probably stay in the same level.
Understood. Weaker margins were present in the reporting quarter, Mr. Krithivasan. Do you feel margins are going to continue to be under pressure in future quarters?
See, our CFO explained yesterday, like weaker margins came in because of, one, we had a higher interventions in terms of increments to employee, not increments, the salary corrections and promotion related expenses in this quarter. We also had it's not one-off, actually, it's a seasonality in terms of non-employee related expenses. But other than that, we are doing okay. But see, always in a growth environment, you have more lever for margin than an environment where we are not growing fast enough. So that challenge we have to overcome.
Mr. Krithivasan, I'm always grateful for your time and your insights on the business and the outlook during these challenging times. We appreciate it, sir. Thank you. K. Krithivasan, the CEO and Managing Director at Tata Consultancy Services. We'll be watching how shares of TCS and other IT majors react when the Indian market opens in about just over 15 minutes' time. Stay with us. We are back in 2 minutes. Right, welcome back. Let's take a look at US equity futures, which are starting to stage something of a modest turnaround. So perhaps these are the markets looking at the best case scenario and maybe, and I'm choosing my words very cautiously here, some prospect of a bargain, negotiation, concession, carve out, however you want to characterize it, but conciliation between the US and China, although the prospects and the optics don't look good when both sides seem to be engaged in what appears to be a very, very potentially damaging retaliatory spiral. We'll leave that for now and turn our attention to the Asian markets, which are a sea of red, although some pockets of resilience on the TAIEX and Jakarta, which is up by 1.7% and 0.3% respectively. Elsewhere, the Japanese markets are back from the lunch break, and let's bring in Lynn now to break down the morning action for us. And it was quite a bruising session for the Nikkei so far, Lynn.
Yeah, hey, Sri, indeed, that is the case. And certainly, you know, we got that relief and this huge bounce back for the Nikkei 225 yesterday. But, you know, this reassessment here, that there seems to be a lot more hurdles to come, particularly in terms of the trade situation, those tariffs between the two largest economies. But also just want to make a note of the fact that we have seen that when it comes to Japanese markets, the moves seem to be more pronounced versus other Asian markets. I've spoken to a few people and they tell me that, this is one of the most liquid markets in Asia, easy to short. It's also one of the first markets to open in the day as well, and a bit of a target for some of those overseas macro funds. But also, of course, it is the Japanese currency, and we have seen an acceleration in terms of the strengthening of the Japanese yen today as well, 143.30, and that is offering downside for a lot of those export-driven stocks as well. Now, one company we are watching very closely is the number one, 11% weighting on the Nikkei 225, Fast Retailing, the owner of Uniqlo, reporting its earnings. And what we're really focused on here is the guidance, because they did talk quite a bit about the tariff impact. Essentially, they've said that they've been front-loading a lot into the US market to get ahead of the tariffs, but they still see that in the second half that could impact profitability here by 2 to 3%. But I think what is also interesting is that their US expansion is potentially at risk here. There's a question mark around that, and that is a concern because they have consistently seen downside in their biggest market, which is, of course, China, Sri.
Lynn, I wanted to talk exactly about that. So if Fast Retailing through Uniqlo is facing challenging times in China and lower sales, then is there a sell China, buy India proposition, and do they deepen their commitment and expansion to the Indian market?
Sri, I think the answer to that is potentially. But let's have a look at the situation, because Fast Retailing, Uniqlo's presence in India at the moment is minuscule, 0.6%. If I was to put it into percentage terms, they only started their sort of presence there only 5 years ago. There's only 15 shops. And to contextualize this for you, the comparable market here, of course, by population is China. And there they have more than 900 stores. So certainly the opportunity is there. It is potentially an exponential opportunity, but let's not forget a couple of things we need to factor in here, which is the tariffs that India imposes as well on garment imports there. And according to sort of some of the calculations I'm looking at, around 10 to 20%. So that's something to factor in as well. And also the fact that, when we talk about what Fast Retailing's management have said about where they see expansion, they've really put a lot of eggs in the basket of North America and of Europe. So let's watch to see if there is a pivot indeed. We heard from the CEO, Tadashi Yanai, where he said that he didn't believe that the tariff regime that the US president has outlined is sustainable. So are they betting on the fact that they feel like this will be negotiated down going forward here? But I think, Sri, the potential, I would say, is there.
Great report, Lynn, and don't even get me started on dad jeans versus skinny. It's a very vexed topic in my household. Anyway, staying with Japan, 6 years in the making, Osaka will open at the World Expo this Saturday. The mood is a far cry from 1970, when Japan's second largest city held its first fair, an economic coming out party. Most locals say they're supportive, but there's been talk of construction delays due to chronic labour shortages, as well as weak ticket sales, leaving concerns about whether Japan can really pull it off. Carrie and Joji went to Osaka for a last-minute pulse check.
The signs are everywhere. Cooks needed. Hiring ASAP. No experience, no problem. All over Japan, cities are buckling under a labor crunch. The country's workforce peaked 30 years ago due to a shrinking and rapidly aging population. Here on the border of the World Expo, Osaka seems stretched to the max. Sakae Ono is on the front line, working at the biggest public employment office in the area. She says all kinds of perks were thrown in to fill vacancies at the expo. She helped an 80-year-old find a job. Plenty were hired on the spot. Too many jobs, not enough applicants, and it's a national dilemma, keeping up with the demand for workers. Hotels, meanwhile, are investing heavily to prepare for the expo because organizers hope more than 28 million people will attend. This one just completed a $90 million makeover. Recruiting started 2 years ago, fearing last-minute hiring might jeopardize the reopen. Why invest now?
We asked owner, could you please complete renovation before the expo? After expo, we will have more inbound tourists from all over the world.
The urge to visit seems endless with or without the expo. A record 14.6 million tourists rained on this megalopolis last year, piling pressure on a tight labor market. Behind the scenes, there's a new generation trying to keep up, who say toiling silently with little or no pay raise is outdated. The fight to retain staff is so fierce that companies agreed to their biggest pay hike in 34 years, fanning hope among workers that finally their time has come. For CNBC, I'm Kaorien Joji in Osaka.
And we are counting down to the market open in India, and this is what the futures picture is telling us. We're looking at a kickoff in the proximity of 23,000 for the Nifty. That's what the futures are signalling, so that would suggest a lift of about 300 or so points. Considering that the market was closed yesterday, there is an element of some pent-up buying demand in the market that is waiting to be unleashed. So these are markets that are going to be taking their cue from the tariff reprieve as opposed to the reversal that is unfolding, continues to unfold in the Asian markets. Let's give you the dollar-rupee rate as well. 86.1350 is where we stand, so stable at that level. Let's get out to CNBC TV18's Mangalam Malu in Mumbai. Tell us what you're watching, Mangalam, ahead of the market open today.
Hey Shri, so the one thing that happened is that our markets were shut yesterday at a time when everyone was hoping for them to be open, given the sort of big rally that we saw on Wall Street the previous night. And then yesterday there was volatility. Some of those gains of the previous night on Wall Street were given back as well. So as a result of which, like you rightly pointed out, the opening is likely to be about 2.5% higher, and this is a lot less than what could have happened in yesterday's trading session. Be that as it may, around 23,000, what is it that people should be looking at? We open right into the resistance zone. Is volatility out of the window yet? Not perhaps. So what's good is that we've made a double bottom at around that 21,750, 21,950, that sort of range, and from there we've recovered. And all the economists, all the experts, all of them are definitely saying that India has an upper hand when it comes to dealing with the US, when it comes to tariffs, as compared to all the other economies, because of the inherent domestic consumption-led nature of India's GDP itself. And even then, there is a bilateral trade agreement or trade talks which are underway between both India as well as the US. The other factor that we're watching out for right now is the earnings season, the beginning of the earnings season. TCS reported its numbers yesterday, and it was slightly on the muted side, but that was something that was expected. All the IT stocks have been under pressure. So the counterbalancing fact on the IT pack would be, one, could global-led recovery or fears abating around tariffs take the IT stocks higher, or could the fundamental weakness of these stocks put them lower? So that's something that we'll most definitely watch out for. For people looking at the Indian market, I would just suggest it's prudent to, wait out for the first couple of hours and not perhaps chase that gap open, because we opened right into resistances, both from a technical standpoint as well as, futures and options positioning, where the 23,000 call on the Nifty has the maximum open interest. So we'll keep an eye out on that. But for all things trade and bilateral agreements, we had a comment coming in from Minister Piyush Goyal. So I suggest you listen into that before, looking at the Indian market open first.
India has been handling the tariff issue wisely for a long time. Prime Minister Narendra Modi and President Donald Trump had decided in February to sign a bilateral trade agreement while strengthening mutual cooperation. This will help India and the United States to make trading easier and smoother. It will also help the two-way trade reach $500 billion. That is 2.5 times more than what it is worth today.
All right, so that was what, the commentary came in from the superpowers, the minister, when it comes to the bilateral talks. As of now, the Indian market showing some signs of recovery after the big gap up that we saw in Wednesday's trading session. We were closed yesterday. Let's say, thank God it's Friday. Back to you, Sri.
Good man, Mangala. My sentiments exactly. Thank you very much indeed for that. Right, and you can read more about where India stands in this trade war on our website and in this week's Inside India newsletter, and how much leverage will it have in the trade talks with the United States. Find out what experts are saying in this very detailed piece, which I commend you to read. Right, we are counting down to the market open in Mumbai, of course, as Mangala said. We're back in 2 minutes. Back, everybody. Indian markets are on the pre-open session, and they are pointing towards some confidence returning to these markets. And the markets in India really keying off the US tariff reprieve as opposed to the reversal, which appears to be unfolding in the rest of the Asian markets. What a week it's been for all of us, including investors in India. We had assurances from the RBI and a 25 basis point cut. That has helped confidence. We've got progress being made in the BTA with the India-US bilateral trade agreement, but it has been a tough week, and it's been a rough week for the exporters, everything from the IT services to pharma. We got some warning shots fired from TCS as well in terms of some of the commentary about the uncertainty. Mr. Krithivasan was talking about that. And then on top of that, we did have some bright spots, and of course they are in the FMCG sector, the domestic companies. Right. Let's take a look at the IT services. Speaking of which, those companies following TCS's report card, they are looking like this. All of them are in the green, having a positive session. And we just spoke to the CEO of TCS, who is hoping the dust will settle on the tariff uncertainty in the next few months. In the meantime, quick check on Adani stocks. The group is expected to start a major copper smelter in India soon, betting on rising demand for the metal in the country's growing economy. And the entire complex beginning the day on a positive note. CEO of Muddy Waters Research, Carson Block, was on Squawk Box Asia this morning, and he talked about his strategy for investing in India and why he would not short the Adani group of stocks. This is what he had to say.
You land at the airport, you see the Adani name. In Mumbai, you see the building, the office building in BKC where the stock exchange is located, and Adani's name is also on the building. In these countries, political clout accounts for something. So no criticism of Hindenburg Research and Nate Anderson, but that's probably not especially if you're not going to be activist, that's probably not the kind of person you'd want to short, or the kind of company you'd want to short, where it's so closely tied to somebody who's very tight with the establishment in India. So I don't think that would be at the top of our list. Now, that said, there are various technical factors with trading India, and there's a futures market, and the 223 largest cap companies in India, they have futures traded on them. And from our perspective, we would only short in the futures market. So just because of liquidity and the ability to get margin there. So there are some things that, and this is one set of issues that we have to understand better, because it's not exactly like trading in the U.S. There are very unique aspects to that market. But yes, if we run a short book, it would be Indian large cap shorts.
Right. US exceptionalism, that story continues to suffer, and that's really a function of a deeply negative scenario still that is being priced for the global economy because of this tariff uncertainty. And with that, let's take a look at the dollar index. And we have seen it slip below the century mark now, DXY at 99.89. Let's bring in Sal Kapoor now, market strategist and head of products at DSP Mutual Fund. Sal, thank you very much indeed for joining us as we wrap up what has been an extraordinary week for global markets and macro, not least of all for India. How would you, on balance, characterise the story this week in the Indian markets? Was it one of resiliency with the RBI standing by, BTA progress, and do we stay invested? And if so, what should we own?
So India has certainly been more resilient than the rest of the world. And even when you look at the market parameters, for example, look at the Indian VIX or the volatility index. When CBOE VIX was at about 55, India was at about 21, 22. Our bond yields, 10-year GSEC has been much stable at about 6.5%, with a lot of volatility globally, but domestically they've been much more stable. Rupee, on the other hand, has been weakening slightly, even when the dollar has sort of corrected a bit. So on the whole, I think India has been much more stable than the rest of the world, but I wouldn't take it as a sign that this stability will continue, largely because earnings growth continues to slip in India. And we've seen by, let's say, about till FY24, we were doing 20% plus earnings growth over a 4-year period in terms of CAGR numbers. Those numbers are now slipping to about, low single digit or mid single digit, which is not very comforting. And yeah, so valuations and earnings, I think, is something which is a big drag on the market here.
Let's just explore that further, Sahil. And IT services really seem to be at the sharp end of the tariffs, despite the tariff differential that works in India's relative favour. Do you feel that the guidance risk from the forthcoming earnings season, and TCS gave us a glimpse of that, has not been fully priced by the market?
Yes, I think so. For IT services, I think most companies have been, over the last few quarters, have been highlighting these risks. It's not new. With these added pressures, I think they will, of course, talk about these risks in more detail. But when you look back, let's say last 3 to 4 years, their earning growth was much more stronger. Before FY24, they were growing at mid double-digit growth rates, and they were also trading at about 30 time plus multiples, almost all of these companies. But with earnings growth less than 5%, I think most of these companies still trade at 25 plus. So I think valuations are still not very comfortable. Second, I think tariffs are yet to play out in the services sector. Services sector hasn't been roped into this tariff war, but
yes,
I think this tariff differential advantage looks like a non-starter to me. The reason is that globally, the tariffs are still one of the highest in the last 100 years. So I think they are going to weigh more through a growth slowdown than through these tariff differential advantages. I think that is a bigger drag for all countries. Yeah.
I see. And there is the second round effect of excess capacity and China's excess capacity in from elsewhere finding a home somewhere. So that is a risk for India too. Did you feel within that context, Sahil, that 25 basis point cut in the repo rate by the RBI this week was enough to stabilise sentiment?
I think RBI has given a clear commentary saying that they will be dovish and probably they will be looking to do more. In that sense, I think it's a good tentative step, not overcommitting at this point because we don't know how things unfold over time. So I think it's a good beginning. But as you know that the backdrop of this tariff or the trade war, currently it seems like it is becoming a more bilateral issue. But history shows that trade wars are never bilateral. They're always multilateral. And I think that step is still pending. So it's better for regulators and policymakers to have some ammunition rather than spend everything upfront.
How cautious do we have to be towards the pharma sector, Sahil? Because it was very clear earlier this week, President Trump made it abundantly clear that the world is going to have to expect major tariffs on pharmaceuticals. And we saw the associated negative reaction on India pharma stocks. How are you approaching them?
So, Sri, there are only 3 or 4 areas in which India's export sector has excelled. One is pharmaceuticals, other is IT, services exports, and there are 2 more sectors like auto and chemicals. But pharmaceuticals, I think, is one sector where India really excels. I think the cost of production for most of these firms are so low that they will be able to, navigate this tough environment. So we will not be perturbed with what happens with this sector particularly. It could become volatile. There could be some more uncertainty and, trying to, discount what the future holds. But I think this sector is probably poised to take it on the chin and still come out much better than the rest of the pack. So I don't think we should be overly concerned with this particular sector because I think India still is the pharmacy of the world and one of the lowest cost producers.
Interesting, Sahil. On a broader regional basis, if not a global basis, do you feel that we are going to see the return of a sell China, buy India narrative? We were talking to Carson Block earlier on today on the program, on our programming, and he certainly feels that long-short strategies within the Indian context that he is actively exploring do have some merit. Do you think, and especially from a valuation point of view, after this drawdown from the highs that we saw in the Indian market, are we going to see a reversal in sentiment in favour of India and away from China?
I'll give you 2 very specific points. Point number 1, I hope this happens, although hope is not a good strategy to see, and we haven't seen this play out in the last 3 years, 4 years. Over the last 4 years, India depicted about 25%, 23% earnings growth CAGR, ROEs of 16% plus, right? And very stable macroeconomic environment. How much flows did we get? Hardly anything. No foreign inflows. In fact, in the last about 6 quarters, we've got the lowest FDI inflow that we've seen over the last 30 years. So I think this is a lot of narrative, hasn't really come out in numbers, even when India was doing very, very well. Second is, as you said, valuations differential. When you look at the numbers, India still trades at 20 times trailing earnings plus at about 15.5% ROE when you look at the top 500 companies. But earnings growth, which I said was 20% plus, has slipped down to about 10% or maybe will slip to single digits. And that, I think, is a problem. So you can't have single-digit earnings growth and still trade at 20 times plus. So we need to have a better multiple. I think once we have that better valuation set in India, then possibly this trade could play out. Because quality of earnings for India, I think, is much superior from the rest of the pack.
Understood. Sahil, we've got about 1 minute left. If 6.7% headline growth for India is at risk, then where does that put FMCG and the banks?
I think banking sector is probably much more resilient. I think their balance sheets are much more resilient. So they will be able to take it much better. In fact, for most of the banking sector, the credit growth still continues to be at a 10% plus trajectory. And without any NPA issue and balance sheet stress, I think they are in an okay-ish position. Plus, they also trade at about 15-year low or 20-year low in terms of valuation. So you shouldn't be too much concerned about that sector as investors. But for FMCG, I think the growth has been a big challenge. Over the last 2-3 years, the growth hasn't come about. In fact, in the last 4 quarters, most companies have reported 1 or 2% volumes growth. And I think that is a challenge. So if volume growth doesn't pick up, I think this sector will probably lag.
Understood. We'll be watching out for that, Sahil. Thank you very much indeed for that. Sahil Kapoor there from DSP Mutual Fund. That's it for Inside India. We will see you next week.